Welcome to the deep dive. Today, we're going to be tackling a pretty bold claim that we saw in a Motley Fool article
Okay.
that just 2 ETFs could be all you need to be set for life financially.
Wow.
So,
That's
is that
right.
really possible? Sounds pretty incredible, right?
Yeah.
So let's unpack this together, see what their argument is all about. Of course, standard disclaimer, we are not financial advisors.
Right.
So treat this as a fun exploration, not personalized advice.
I think what's interesting here is that the article isn't just about, picking the right ETFs.
Okay.
It's really pushing like a long-term investment philosophy, which is something we always encourage.
Yeah, totally. And they're using ETFs as the vehicle for that strategy. So for anyone who needs like a super quick refresher, ETFs are like baskets of stocks, right? It's an easy way to get that diversification without having to pick individual companies.
Exactly. Now, Motley Fool's been around since '93, and they're known for their, shall we say, optimistic view of the market. So keeping that in mind, I think, could be helpful when we look at their ETF picks.
Okay, so let's get to the heart of it. Which ETFs do they think are going to make us all millionaires?
Well, the first one they highlight is the Vanguard Total Stock Market ETF, ticker symbol VTI.
Okay.
It's massive, holding over 3,600 U.S. companies as of the end of last year,
Wow.
and it's weighted by market value.
Wait, so the bigger the company, the bigger its influence on the ETF's performance. That makes sense.
Yeah.
I never really thought about it that way.
It's a common way to structure these broad market ETFs. And looking at VTI's top holdings, you've got the usual suspects. As of December 31st, 2024, Apple, Microsoft, Nvidia, Tesla, Berkshire Hathaway. Pretty much the who's who
Yeah.
of the U.S. market.
Those are definitely the companies that you hear about all the time. Okay, so VTI is covering the U.S. side of things, but what about the rest of the world?
That's where their second pick comes in, the Vanguard Total International Stock ETF, ticker symbol VXUS.
Okay.
And if VTI was big, this one's even bigger, holding over 8,500 international companies. Talk about diversification.
Wow, 8,500. That's mind-blowing. Are the companies in there as well known as like the VTI ones?
Some are, some aren't. You've got global giants like Nestle, food and beverage company, which I think a lot of people would recognize. But then you have companies like Taiwan Semiconductor Manufacturing, which might not be a household name, but plays a huge role in the tech world, especially with all this buzz around AI chips these days.
Okay, that's really interesting. So VTI gives you the U.S. exposure. VXUS takes you global. But why this specific combination? What's the Motley Fool's grand theory here?
Well, their argument is twofold. Firstly, they're banking on the U.S. economy remaining strong, providing a solid foundation for growth.
Okay.
Secondly, they believe that international exposure broadens opportunities and helps to manage risk. It's that classic don't put all your eggs in one basket philosophy.
Makes sense. But is it really as simple as picking these two and calling it a day? I mean, can 2 ETFs truly be the key to lifetime financial security?
That's the million-dollar question, isn't it? Well, the simplicity is appealing. And both VTI and VSUS have incredibly low expense ratios, which is fantastic for long-term growth. I think it's important to dig a little deeper. Motley Fool is known for their bold claims, but even they wouldn't say this is the only thing you need to do.
So what are some of the things that the article might be glossing over? Where does this 2 ETF strategy fall short?
Well, one thing that jumps out is that they're only talking about stocks. Depending on your risk tolerance, your age, your financial goals, you might want to think about adding other asset classes to the mix, like bonds, real estate, or even commodities.
Right. Bonds, for example, are often considered less risky than stocks and can provide a nice, steady income stream. So maybe 2 ETFs are a great starting point, but they might not be the whole picture, especially if you're looking to build a really personalized portfolio.
Exactly. And I think that's where this deep dive gets really interesting. How do we take these basic building blocks and create something that works for you, the listener?
I love that. So we've got the foundation, VTI for U.S. exposure, VXUS for international diversification. Now let's explore what we can build on that foundation to make it truly your own.
I'm ready when you are. Let's dive into those details. So we've established these 2 ETFs as potential cornerstones, but let's be clear, they're not about picking individual winners.
Right.
It's more about, broad exposure, right?
Right, but I have to admit I'm a little curious. With thousands of companies in these ETFs, are there any that stand out? Anything that would make me go, ooh, I want to learn more about that one?
That's actually a really smart way to use these ETFs. They could be a launch pad for deeper research.
Okay.
For example, within VTI, you'll find Tesla. Everyone knows Tesla.
Uh-huh.
But what's fascinating is how its performance ties into the whole electric vehicle revolution, renewable energy trends. It's a microcosm of bigger shifts in the market.
Ooh, I like that. It's not just about owning a tiny piece of Tesla. It's about understanding what that ownership represents in the bigger picture.
Exactly. And on the international side, within VXUS, there's Taiwan Semiconductor Manufacturing. We touched on it earlier.
Yeah.
But they're basically the backbone of the chip industry, powering everything from our smartphones to, those AI systems that everyone's talking about.
So if I'm bullish on AI's future, even owning a tiny sliver of Taiwan Semiconductor through VXUS is kind of placing a bet on that whole sector without having to pick individual winners and losers.
Precisely. And that's one of the beauties of these broad ETFs. They give you a taste of so many different sectors and trends.
This is why I love deep dives. You start with a simple idea. 2 ETFs, and suddenly we're talking about the future of tech and global megatrends.
I know, right?
Okay, so we've looked at individual companies, but back to the strategy itself. Are there any downsides to this 2 ETF approach that we should be aware of?
Well, one potential downside is that you're limited to the specific holdings of those 2 ETFs. Even though they're incredibly diverse, they might not perfectly align with your investment goals or risk tolerance.
That's a good point. For example, if I'm super passionate about, say, sustainable investing, VTI and VXUS might have some companies that align with that, but they also include companies that don't.
Exactly. So while these ETFs can provide a solid base, you might need to supplement them with more targeted investments. If you have very specific criteria, for example, there are ETFs that focus specifically on environmental, social, and governance factors, or ESG for short.
Right. So maybe instead of just 2 ETFs for life, it's more like 2 ETFs as your core, and then you build from there.
I think that's a much more nuanced and realistic way to approach it. It's about finding that balance between broad market exposure and personalized tailoring.
Okay, so let's say I'm sold on the idea of VTI and VXUS as my core holdings. Where do bonds fit into all of this? You mentioned them earlier as a potential addition to the mix.
Bonds are interesting because they're generally considered less risky than stocks. They can provide a steadier income stream, which can be really appealing, especially as you get closer to retirement.
Okay, so let me try to put this all together. I start with VTI and VXUS for broad stock market exposure. Then I think about adding bonds for stability and income. Am I on the right track?
You're absolutely getting it. The key is to think about your personal circumstances, your age, your risk tolerance, your financial goals. There's no one-size-fits-all formula here.
This is starting to feel a bit like a choose-your-own-adventure book for investors. Which path will you choose?
Exactly. And one of the most common questions we get is about how much of your portfolio should be in stocks versus bonds. It's a classic asset allocation puzzle.
Ooh, asset allocation. That sounds fancy. Break it down for us. What exactly does that mean?
It's basically deciding how to divide your money across different asset classes like stocks, bonds, real estate, and so on.
Okay.
The idea is that by spreading your investments, you can potentially reduce your overall risk and smooth out your returns over time.
So it's like diversification, but on a bigger scale. Instead of just diversifying within stocks, you're diversifying across different types of investments.
You've got it. It's another layer of risk management and the specific mix of stocks, bonds, and other assets that's right for you will depend on a whole bunch of factors.
This is making my head spin a little, but in a good way. So let's recap what we've covered so far. We started with this bold claim of 2 ETFs for life. But as we dug deeper, we realized it's more nuanced than that. VTI and VXUS can be great building blocks for a diversified portfolio, especially for beginners. They're simple, low cost, and provide broad market exposure. But it's important to consider adding other asset classes, like bonds, and to think about your overall asset allocation. Based on your personal circumstances, what else should we be thinking about?
Well, remember that the Motley Fool article focused solely on the U.S. and international stock markets.
Okay.
But there's a whole world of alternative investments out there, each with its own set of risks and potential rewards.
Ooh, alternative investments. Now we're talking. What are some examples of those?
Things like real estate, commodities, precious metals, even cryptocurrencies. These can be more complex and volatile than traditional stocks and bonds. But they can also offer diversification benefits and the potential for dinner returns.
So it's like adding even more spice to the investment mix.
Exactly. It's about moving beyond the basics and exploring different flavors to create a portfolio that truly reflects your individual tastes and goals.
Okay, I am so on board with this culinary metaphor, but before we get too carried away, with exotic ingredients, let's bring it back to our core audience. For someone who's just starting out on their investment journey, or maybe feeling a bit overwhelmed by all these options, what's the key takeaway here?
I think the most important thing is to start simple and focus on building a solid foundation. That could mean starting with just VTI and VXUS, or maybe adding a bond ETF to the mix. The key is to get started, to get comfortable with the process, and to keep learning along the way.
That's such great advice. Don't let the fear of the unknown or the complexity of the financial world paralyze you. Start small, learn as you go, and gradually build up your knowledge and confidence.
And don't be afraid to seek guidance from a financial advisor. If you need help navigating the complexities, they can help you create a personalized plan that aligns with your goals and risk tolerance.
Absolutely. All right, so we've covered a lot of ground in this deep dive, moving from a simple idea of two ETFs to a much broader discussion about diversification, asset allocation, and even alternative investments. Before we wrap things up, I want to leave our listeners with a final thought to ponder.
I'm all ears. What's on your mind?
Oh, we've talked about the importance of diversification, but I'm curious, is there such a thing as too much diversification?
Ooh, that's a great question. And it's one that we'll definitely need to explore further. Stay tuned, folks, because we're just getting started.
Okay, so before we went to that last break, we were starting to get into this idea of whether there's a point where diversification becomes a bad thing. I mean, we've all heard the saying, don't put all your eggs in one basket.
Right.
But what if you have so many baskets that you can't even keep track of them anymore?
Yeah, that's a really smart question. And it gets to the heart of, what diversification is really about. It's not just about owning as many different things as possible. It's about strategically spreading your investments across assets that react differently to market conditions.
So it's like if one basket falls, you don't want all your eggs to break at the same time.
Exactly.
But you also don't want to be running around with hundreds of tiny baskets, right?
Right.
There's got to be a balance.
Exactly. And that balance is going to be different for everyone. It depends on, your risk tolerance, your time horizon, your financial goals. For someone just starting out, a simple 2 ETF portfolio might be perfectly adequate. They're getting that broad market exposure, keeping fees low, and it's easy to manage.
But as you become more experienced or your financial situation changes, that's when you might start to think about fine-tuning, right?
Right.
Adding more specialized investments or adjusting your asset allocation.
Exactly. And that's where the idea of, over-diversification comes in. Imagine owning a tiny sliver of every company in the world. Your portfolio would perfectly mimic the global market's performance. But you wouldn't be able to outperform it. You'd just be riding the average.
So it's not about simply having a lot of investments. It's about having the right investments for your specific situation.
That's a great way to put it. And remember, diversification isn't just about the number of investments you have. It's also about the types of assets you hold. Stocks, bonds, real estate, commodities. Each of those asset classes behaves differently in different market conditions.
So if one asset class is struggling, another one might be doing well, which helps to smooth out your overall returns. That's the whole point, right?
Exactly.
To create a portfolio that can weather the inevitable ups and downs of the market.
Absolutely. And that's why we talk about things like asset allocation and risk tolerance. It's about understanding how different assets behave and building a portfolio that aligns with your personal comfort level and your long-term goals.
Okay, so let's bring it all back to this idea of 2 ETFs for life. We've explored the pros and cons. We've looked at potential additions like bonds and even dipped our toes into the world of alternative investments. What's the final verdict? Is it a thumbs up, a thumbs down, or somewhere in between?
I'd say it's a conditional thumbs up.
Okay.
VTI and VXUS can be a fantastic foundation for a diversified portfolio, especially for beginners. They're simple, low cost, and provide broad market exposure.
But, and there's always a but, isn't there?
But it's important to remember that they're just a starting point. As your investment knowledge grows and your financial situation evolves, you'll likely want to add more personalized elements to your portfolio.
So it's not about blindly following a formula. It's about understanding the principles and then applying them to your unique circumstances.
Exactly. And that's where the real fun begins. It's about becoming an active participant in your financial journey, learning about different investment options, and making informed decisions that align with your goals and values.
I love that. It's not just about the money. It's about taking control of your financial future and shaping it in a way that reflects who you are and what you want to achieve.
That's the power of investing. It's about building a brighter future for yourself and your loved ones.
Well said. This has been an incredible deep dive into the world of ETFs. We started with a simple question: can 2 ETFs set you up for life? And we ended up exploring a whole range of investment concepts and strategies.
It just goes to show that even the simplest ideas can lead to fascinating insights and new avenues for exploration.
Absolutely. So for everyone listening out there, we hope this deep dive has inspired you to learn more about investing and to start taking steps towards building your own path to financial freedom.
Remember, it's a journey, not a destination. Enjoy the process. Keep learning, and never be afraid to ask questions.
And that brings us to the end of this deep dive. Thanks for joining us, and we'll catch you next time for another adventure into the world of finance and investing.